Have you ever watched your AUD JPY trade suddenly plummet, tearing right through your stop loss with no obvious market catalyst? You check the financial feeds for a surprise central bank announcement or an emergency rate hike, but the economic calendar is completely blank. As this timeline illustrates, official reports like GDP are lagging indicators. They provide a summary of what happened months ago rather than what is happening right now. To gain a predictive edge, you have to look at the raw materials that institutions secure before they begin a new phase of expansion. That leads us to the industrial metal known as Dr. Copper, an asset so closely linked to the economy, analysts say it has a PhD. Tracking copper's price action shows you where industrial capital is moving before the first news report is even written. Gold serves as a static store of value, but copper is a physical building block. It's an essential component in everything from urban construction to the manufacturing of electric vehicles. When corporate leaders feel confident in future growth, they authorize long-term infrastructure and manufacturing projects. Those decisions drive up the immediate demand for copper. Because these massive capital commitments happen at the start of a production cycle, a rising copper price reflects real corporate confidence rather than speculative sentiment. Tracking copper provides a live, real-time diagnostic test of global economic health, signaling expansion or contraction long before the official statistics are compiled. To see where this demand starts, you have to look at China. This single nation consumes over 50% of the world's copper supply. When the Chinese economy accelerates its building and manufacturing, global copper demand rises almost instantly. This chart shows the causal link. Traders monitor specific Chinese data points, like manufacturing PMIs and fixed asset investment, to forecast shifts in copper demand. A stronger than expected reading in these reports often acts as a catalyst, pushing copper futures higher. Monitoring China's industrial output is the most reliable way to anticipate how copper demand will shift in the coming months. This physical demand translates directly into digital currency fluctuations through the lens of global risk sentiment. When copper rises, signaling growth, capital flows into commodity exporting currencies in a risk-on move. The Australian dollar is the primary beneficiary. Australia is a massive exporter of the raw materials needed to fuel China's industrial machine. If copper falls, signaling a slowdown, investors shift into risk-off mode, moving capital into safe haven currencies like the Japanese yen and US dollar. Combining these forces creates sensitive pairs like the AUD JPY, which move in response to the tug of war between growth and fear. Copper acts as the transmission wire, turning physical industrial activity in China into pip movements in the currency markets. While highly accurate, Dr. Copper can occasionally give false signals due to factors outside of industrial demand. Sudden supply shocks, like a major mining strike in South America, can artificially spike prices even if true industrial demand is actually weakening. Before entering a trade, verify that a move in copper is backed by strong Chinese economic data to ensure you are trading real demand rather than a supply glitch. To apply this, add copper futures to your charting platform and overlay them against pairs like the AUD JPY. Use technical analysis to identify a setup. Then use a copper breakout and Chinese PMI data to confirm the entry. By utilizing physical commodities as a macro indicator, you transition from a reactive trader to one who anticipates the trajectory of the global